Treasury yields just dipped, and the entire bond market is now locked on one number. At the time this video was made, the 10-year Treasury yield fell 2 basis points to 4.672%, as traders digested a tame July inflation print and turned toward the next big test, wholesale inflation. The trigger was the consumer side. July CPI rose just 0.1% month over month in inline reading. And when inflation cools, Treasury yields often drop because traders start pricing a lower probability of further Fed tightening. Cooling prices, falling yields, that is the trade on the tape right now. The yield curve tells a clear story. The 10-year note fell 2 basis points to 4.672%. The 2-year note, the most rate-sensitive part of the curve, dropped more than 2 basis points to 4.178, and the 30-year bond slipped less than 1 basis point to 5.238. Here is the mechanism. When inflation data lands, yields adjust to shifting expectations for Fed policy. A cool print pulls yields down as tightening bets fade. A hot print does the opposite and drives yields higher as the market recalibrates. The 2-year is the signal. It is where short-term rate expectations live. And you can see the inverse relationship on the tape. Over the last 30 days, TLT, the fund tracking long-term treasuries, is down 2.25%. Over that same stretch, SPY, tracking the broader market, is up 2.49%. Falling yields, rising stocks. Sentiment confirms the risk on tone. The Fear and Greed Index sits at 68, firmly in greed territory. And on Wall Street bets, sentiment reads 0.03 across 2,748 mentions, a crowd waiting for the next catalyst. Wall Street is leaning the same way. Goldman Sachs wrote that most FOMC voters would likely view the expected July inflation numbers as acceptable and would want to see the August CPI and PPI before deciding whether to hike in September. Deutsche Bank's Jim Reed added that 2 consecutive encouraging core reports, combined with weaker employment data, could leave less pressure on the Fed to act immediately. So here is the question that matters. Does wholesale inflation confirm the cooling or break it? Here's what the market expects. The July Producer Price Index, what wholesalers pay for raw goods and materials, is forecast to rise 0.2% from the prior month. That follows July CPI at 0.1%. 2 tame prints side by side are exactly what the bond market is betting on. What matters next? 1. The PPI release lands at 8:30 a.m. Eastern, and the print relative to that 0.2% expectation sets the immediate tone for bonds. 2. Watch the 2-year at 4.178, the barometer for short-term rate expectations. And 3. The August CPI and PPI reports could play a significant role in shaping the September policy decision. At the time this video was made, 4.672% on the 10-year is the line. A decisive break below it on a soft PPI print could signal a more sustained shift in rate expectations. Markets like this are exactly why a plan matters. At startwithtA.com, you get daily market briefings, real trade setups, and the levels that matter before the crowd sees them. Start your journey at startwithtA.com. The link is below. That's the briefing. Subscribe for daily market analysis from the Traders Agency team. This is education, not financial advice. Trade smart.